How are you?
I'm good, and you?
Good, good. Happy New Year.
Happy New Year to you. I don't know when we're gonna put this out, but well, for those of you watching, it is our first PLA of the new year of 2026. So very happy New Year to you, Bruno, and all the best for the coming year.
Oh, you too.
Perfect. And as normal, we're coming back. We're going to do some questions that we have received over the December period. Bruno, I'll start with yours today. And basically, what the question that we're going to give you today relates to family planning, which is a question that we get a lot from clients. Specifically, obviously, there's a lot that goes into family planning and a lot of discussions, but we're going to try and restrain you today just to dealing with disposition of immovable properties, in particular, people who have an intention to dispose of their immovable properties to their heirs prior to them passing, rather than obviously passing on immovable properties within their wills. What are some of the things to consider? What are some of the pitfalls that people should look out for?
So, how do you move immovable properties to your heirs before passing away? And this is part of the family planning and estate planning, where individuals with assets, movable properties and other assets, any other assets, are trying to get these assets out of their name into the names of their children, as an example, or other people that should benefit from these assets. Now, why would somebody want to do this before they pass away? And there's a number of different reasons for this, including tax consequences, but also just planning. If you're getting to an age where you might not be able to take care of these assets, you might want your children to start enjoying them or leveraging them. So a lot of people use this as planning mechanisms to make sure that what happens today benefits those heirs as opposed to them having to wait. Now, bear in mind as well that there's a lot that comes behind some of these assets, and a lot of transactions and a lot of operating that can happen, whether it be a business or a property rentals and income generated from that. So passing these on to your beneficiaries can actually allow them to not only gain this income, but also gain the capital growth that comes along with these assets. And this basically freezes the capital growth, because as long as the capital growth is in your name, unfortunately, when you pass away, that capital growth is then going to be taxed with capital gains tax. Why we want to sometimes move this to our children ahead of time is because we don't want our estate to have to pay the capital gains tax. We'd rather freeze it, dispose of it, pay the capital gains tax up until this moment in time, but move all future capital gains into the children's name. So there's a number of different reasons again. So there's three things that one needs to consider, especially when it comes to immovable properties. And this is the cost stack. Right? Now, when moving immovable property, there's often donations tax, there's capital gains tax, and there's transfer duty. So those are the three common taxes that are related to moving immovable property that will always in some form or another apply. Now, a very important thing to say now is that SARS is aware of all the different mechanisms that we make use of in order to apply and effect these transactions. So you should not structure your affairs in order to only be tax efficient, because unfortunately then you lose the flexibility of being able to change, because SARS might change the law, but now you're stuck in a rigid structure that does not suit you. So it is very important to first focus on other aspects and not tax as your only consideration. So as I mentioned, benefiting your children. That's one very, very big important one. Freezing capital gains, yes, it's a tax consequence, but at the end of the day, it does help you in your estate planning. Moving it to your children now so that they can operate it better than you, not just for their benefit, but because you might not be able to. That's also a very important one. And one very crucial one is avoiding family feuds. Because unfortunately, if everything's left to the will and you're not around to be able to fix any disputes or resolve any disputes, it now sits on the executor to try and resolve disputes. So that is also working within the family framework is also crucial when it comes to this sort of planning. So the cost stack is there. Now, there's two ways of normally attending to this. The first is by way of a donation. Now, donations are expensive. You're looking at a massive amount, 20% tax being paid on the value of your donation. In addition to that, capital gains will still apply to the donation because it is considered to be a disposal. So you would still have to pay capital gains. And lastly, transfer duty will likely apply. Now, bear in mind, again, another qualification to this, I'm not speaking about the movement of assets into the name of the spouse. I'm more focusing on moving the assets into the intended beneficiaries. So basically, when you and your spouse pass away, where you'd want these assets to land up. And that's more the focus because that's better estate planning. Moving to your spouse, there's plenty of rollover relief that you can rely on. And that's why in this video, we don't really explore that relief because it is there in our law and it's very well known. So that's mechanism number one, donations. It tends to be the cleanest because then it's done. It's over. The problem with it is it's not cost effective because of the donations tax that has to be paid. So the second mechanism is usually done by way of a sale where you'd expect your heirs to actually buy these assets from you, but it's rare that they will actually buy it. So I normally recommend, if there is affordability, that the heirs actually take out a bond, buy it from you, and pay you the cash, so at least you have the cash. That's not great for estate planning because then you're sitting with a bunch of cash, but you know what, it might be part of your retirement plan, get rid of the asset and actually utilize the cash to do whatever you want to do. But right? That really happens. And often what we find is, and I call this the loan trap. Everyone believes they can just transfer a property and the purchase price will sit on a loan. And this is very, very dangerous because that loan is still an asset in your estate, right? Meaning that that loan has to be repaid. And now there's a number of consequences on when this loan has to be written off. Again, tax consequences. So be very careful with this. And also another trap that I find is when people transfer these assets or this property into a trust, they believe they transferred it and now this purchase price is sitting on loan account. Unfortunately, again, SARS has picked this up. So Section 7C now looks at this loan account and determines what interest rate should be charged on this loan account. And if you, as the seller, are not charging interest on the purchase price that hasn't been paid to you, SARS will consider that interest, the shortfall in the interest, as a donation. Now, bear in mind, that sounds good. It's like, oh, but the shortfall in the interest per year, that doesn't seem that much. It's a couple of percentages on the interest in a year might not be that much, but now it accumulates year after year. Remember, donations tax is 20% once off. Now you're looking at this interest, right? And year after year. So as soon as a couple of years start accumulating, it actually starts becoming more than the donations tax. So be very, very careful with this. Planning with a loan account has its time and place, but it has to be done properly. What I do normally recommend is start planning your estate from now, so that if you are planning in the future to move things into a trust, rather buy things in the trust now and allow the trust to take on that capital growth. So final word, please do not plan your estate based purely on tax. It has to have better reasoning than just tax. And tax then comes behind this and supports the structure that you choose. Complicated tax planning leads to complications in your estate and unfortunately restructuring later if the tax situation or position has suddenly changed. It has short-term benefits. Very seldom does it have long-term benefits because these are covered and these loopholes are closed. Trusts have been around for years. You can trust the trust will be there. Just don't try to do anything with the trust that isn't apparent, isn't transparent, because once it comes to light, unfortunately, this is when you're likely to be penalized or the law is likely to change and you're going to have to shuffle and restructure it.
Absolutely. Thank you for that, Bruno.